Hello, everybody. Welcome to another episode of My Money Panda by Wealthy Nivesh. So, when it comes to market, there is something which is synonym with it, and that is volatility. And no segment of market shows it as strong as small and mid cap. And if you look at last 2-3 years, they have seen all kinds of W, V, Y kinds of recoveries and downfalls. To discuss the same with us today, we have got Pranav Gokhale, who is a senior fund manager with Canara Robeco Asset Management Company. Pranav brings with him 23 years of work experience across analysis, research, and fund management. So, welcome, Pranav. Welcome to the show.
Thank you. Thank you for having me here.
So, Pranav, to start with, if you can, take us through the journey of a small and mid cap in last 2-3 years. So, I understand after Corona there was huge rally. So, but beyond that, after September, they started having correction. Before that, also from December 22. April 23, they had some correction. So if you can take us through the journey of a small and mid cap as a segment for last 2-3 years, and how do you see them currently, valuation wise?
Sure. So very apt question as regards the timing, the way things are unfolding now. Well, I like it to take you back before Corona times. Mid and small caps or market as a whole, the earning growth wasn't happening much. What happened post-COVID was we've seen significant amount of earnings growth. Mid and small cap indices as a whole had earnings growth exceeding mid-20s to early 30s. This led to an overall improvement, and which led to these kind of run-ups in mid and small cap, which we have witnessed over the last 3-4 years. Having said that, after having these kind of earning growth over the past 3 years in terms of compounding basis, we came across a scenario where earning growth started to decelerate a bit. It kind of moved towards mid-20s, then towards early teens.
And when was that?
So this started off over a year back, where they start moving down, and probably we foresee earning growth closer to mid-teens or early teens. And this has led to a bit of a correction in these markets. So if you look at the market over the last 6 months, the mid and small cap indices have corrected somewhere between 18 to 20%. Given the context, they are still trading to about 15% premium to their long-term averages.
Trailing basis.
On a trailing 12-month basis. And incrementally, if this earnings doesn't go through, we could see a further bit more of a correction coming in these mid and small cap segments.
Okay. So you mentioned that they are at around 15% premium. If I take a step back, in the month of September, they were trading at around 30% premium to their long-term averages, 5-year and 10-year. And we took a call that now they are very expensive, and now we should shift to hybrid kinds of philosophy, and that worked very well. So while small and mid cap went down by 20 to 25%, hybrids went down by 5 to 10% only. So my next question to you is ki, a very dreaded term for a wealth manager is historical returns. It is a very dear term also and dreaded also. I'll tell you why. So if I'm a typical salesman, I will show the returns and I will get you invested. Okay, these are the highest. But we know, between you and me, that is not a scientific approach to get invested. What has happened recently after this small and mid cap rally, a lot of retail investors came into this segment without properly understanding the volatility and risk associated with the small and mid cap. And now, what happens now, they are seeing their portfolio went up from 100 to 200, and now from 200 it's down to 90, 100 or 110. So do you see this segment of investors, that is retail investors, contributing to more risk in coming days?
One positive aspect which has happened is more and more retail investors have actually come in the market.
Correct.
The positive aspect of it is that they will be able to generate wealth if they use financial prudence. Why financial prudence? If you're investing in companies with decent return ratios, cash flows, and companies which will generate above average kind of a profit growth, you're bound to make returns over the longer term. But what has happened is we have seen market rally across mid and small cap. So what has happened is investors who were chasing returns rather than investing actually have suffered more, because in the zest to make quick returns, perhaps the investment in certain companies which were momentum based rather than just earnings based, and that has kind of created a bit of a sour taste. So my advice is stick to companies where you actually know that there is a longer term business model is in place, and where earnings growth profile will be reasonable, as well as when there will be return ratios and cash flows to support these kind of an earnings growth. I think those companies are something which one should stay invested in, and returns will be more of an outcome of how these economies of these companies will do.
So Pranav, you mentioned about momentum investing, correct? So when it comes to traditional ways of investing, there is value investing, growth investing. Some people go for technicals, some go for fundamentals. Momentum is comparatively newer strategy.
Correct.
So can you share your views about momentum as a strategy for investments?
See, momentum investing should be, according to me, largely done by people who understand it and who can take quick decisions. It becomes very difficult for you to really understand when the movement is shifting between the sectors, between the market caps or across the
Yes.
market caps, and between companies within the same space as well. So unless and until you have a tight hold on that particular set of companies or that set of sectors, I think the chances of success are very little, or it should be best left to those experts within that space to take care of it. So I would still believe that for a normal retail investors, rather than going through that things, if they stick themselves to more about growth centric investment, investing in decent quality names backed by able promoters and companies which generate return ratios, I think the chances or the probability of success is much higher over there.
Great. Pranav, so at Wealthy Niveshna, we look at mutual funds in two, three broad segments only. So we never go for sector thematic kinds of ideas. And we either, so at a high level, we look at hybrids and pure equity. And under equity, we look at small, mid, and large cap. And the reason we broadly segregate them is because we believe that there is different approach when it comes to investing into a small cap as compared to a large cap. So can you take us and take our audience through what are the differences in approach when you are analyzing a large cap company to invest into or versus when you are analyzing a small cap company to invest into?
Yeah. So basically, large caps, if you look, the market cap is larger. There are more research companies. There are more known companies. When it comes to small cap, if I have to bracket the companies, I bracket them into three, four broad parameters. One is there could be companies which are leaders in their own space, but where the market cap itself or the profit pool itself is not so large, which makes them small cap. To give you an example, there could be companies in the bearing space where there are MNC companies, but who could be small cap in nature, but they are leaders in their space. So that is one bracket. The other bracket is there are companies who have a niche business model and who are trying to create or be part of a larger profit pool. So where the business model is more evolving, and that is where those companies, the returns could be significant, but the chances of failure are equally high. And then there are companies which are small cap companies who are small cap because currently they are a very small percentage of profit pool, and they are looking forward to gaining market share from these mid cap, large cap companies and growing in that space. So if I have to bucket across these three parameters and then try to identify companies, I think it should be a blend of all these three. When I compare it to large caps, they are more to that extent evolved companies, and in that case, the ability to go wrong is slightly lower. But when it comes to these small cap companies, especially the one which are more evolving or which there is a niche model, because there is always a chance to have some kind of an obsolescence coming in, either a new product coming in or a new technology coming in and disrupting in a big way. So which is where I believe that is where one should be careful. When I say careful, what do you want to do? Maybe position yourself in such a way that those components are far and few or have specific weights, and then concentrating more on these companies which are larger or market leaders in that small cap space, and then looking for a small blend of companies which are in the space where they are challenging market leaders or they are trying to garner market share within the small cap space.
Great. So Pranav, when it comes to investment, there are two dimensions. One is market side, the other is investor side. Correct. And let's say let's take two scenarios in today's time. One is where investor is invested dominantly into large caps and hybrids. The other is where he has built a multi-cap kind of portfolio and he has got large cap, mid cap, small cap, all three. Do you think, and I'll tell you my views about it, and I'm completely okay if you disagree to it. Um, do you think current market volatility in a small and mid cap, which both of us agree can extend up to next 7, 8, or even 1 year, can be good allocation time for those people who until now didn't have exposure to small and mid cap, and they can use this opportunity to build a small and mid cap portfolio? What are your views about it?
Sure. So we are coming at a stage where the overvaluation zone is kind of off, and we are looking at more about palatable valuations. The risk which we carry is the earning risk. So in this current scenario, if someone doesn't have a exposure in mid and small cap, I think it's a better time to start allocating during this downturn, because today you will get these companies at valuations which are more towards their means. Correct. And then the propensity to make alpha increases in a reasonable way. In fact, I always make this statement: be greedy when others are fearful, and be fearful when others are greedy. I think as the market is turning a bit towards being fearful, there will be a time when you can be a bit greedy about asset allocation to some of these mid and small cap companies.
So what you are trying to say is that even though they are at slightly premium, and in coming days they can face volatility, this volatility can be good staggered exposure opportunity for those who don't have any exposure in small and mid cap.
Absolutely.
Correct. And what about those people who are still sitting on small and mid cap? I'll tell you our own experience. So starting from June 24th, we started advising clients to shift from small and mid cap to hybrids or large caps because of very stretched valuations of small and mid cap, and that helped us. But there were still many clients who were like, and that's a very typical statement that we keep on coming across कि they are giving 35-40% annualized return. कम होते होते कितना हो जाएगा? 15% हो जाएगा, 10% हो जाएगा. You try to tell them कि it can go even negative, but they don't ascribe to that notion. So there may be some people who are still sitting on a small and mid cap. What are your suggestion to those people?
See, there is a bit more pain in the offing, which could possibly happen. But I think the pain from being extremely overvalued to having more of a palatable valuation, we have already passed that stage. Witness about 20% correction in indices. Many of the stock, the correction has been as much as 30 to 40%. Incrementally, there could be a few further bouts of correction which could happen. But during these times, I think it is better that you have incremental allocations, and rather than selling it at a time when it is closer to the mean. So it is always better to stagger it that way. Rather than being timing or time conscious, it is important to being valuation conscious in mid and small cap, and which is where when they actually go below the mean or the longer term mean, and one has a visibility on earnings growth, I think that is a better time to in fact invest in some of these mid and small cap names.
So Pranav, I think enough of market discussion. So now, let's move towards investor side. Those timeless kind of principles which everybody should employ. So let's say I am into late 30s. I'm earning 4-5 lakhs or 3 lakhs per month, and I have got investable surplus of at least 1 lakh per month. Or say I am somebody who can start 1 lakh rupees SIP. And I am a layman. I don't have much background in investments or finance. So how would you, suggest me to start my journey?
See, asset allocation calls are the most important calls. They make a significant amount of difference between wealth creation.
ठीक है. So asset allocation आपको decide करना चाहिए.
So that
on
is
what parameters?
It is based on an individual risk parameters. To each is his own is the principle. Because it should be more target oriented according to me than just being a return oriented. So a person who may not have a house may long to have a
Buy a
house,
house.
buy a house. In that case, the asset allocation will be more towards where the capital preservation is also equally important. The return also is an important thing, but not the primary thing. There could be a scenario where you're doing it maybe for your child's education 20 years down the line.
But you should
Which
have a plan in
plan
place.
in place. So it should, which is where the target asset allocation comes in. So that is where I believe that where you could have a larger amount of risk and look more towards longer term, which can create you that alpha over 20 years. So I think that is a better approach to do it done within the individual space as well. Or when you look at individuals also, just break what you want it, maybe your retirement kitty, maybe your education loan, maybe your housing loan, and then stagger the asset allocation to meet the purpose.
So for the benefit of audience, asset allocation means that there are different asset classes in the market. There is equity, there is debt, there is gold, there is bank FD. So you need to decide how much of your investable surplus should go into which asset class in what proportion. So that is known as asset class. And you decide asset class basis your investment horizon, for how much time period you are investing into it, your risk appetite, how much volatility you are ready to face, your taxation, whether it is more tax efficient for you to invest into a arbitrage fund as compared to a bank FD, and certainly your life goals. So, Pranav, I believe when it comes to investment, uh, rather let's say money management, your investment amount is a function of two parameters. One is how much you can invest, that is income minus expenses, and second is how much you should invest, which is as you said ki for my kids education, for buying that house, for buying that dream car, I'll have a horizon. I will say ki I want to buy this car in 5 years, this is its current price, in 5 years it will reach this much price. So if I assume let's say 12% return, how much SIP should I start with? So what are your views? Which parameter should be more prominent? How much I can invest or how much should I invest? Or it's like both should have equal weightage?
See, I'll tell you the principle which I follow. I don't follow the principle of income minus expenses savings. Rather, I follow the principle of income minus savings is equal to expenditure. It is always better to be a bit frugal. I'm not saying that we should be stingy, but you should have more about that savings. So that should be given more of a priority, and then expenditures come later on.
So such a beautiful point. Invest first and then spend.
Yeah. So save first. That
Great,
is
great.
yeah.
So you are saying कि instead of fixing your investment levels, first do an analysis of your expenditures, see how much less you can have it, and then you decide your savings level.
Correct.
So that reminds me of a very good anecdote. Rakesh Jhunjhunwala in one of his interviews mentioned that if I lose my wealth by 90%, still I will have same cigars, same liquor, same foreign trip, and same lifestyle, same car as well. So one way of looking at it is कि you should have ample amount of money. The other way of looking at it can be कि your expenses should always be much lesser than your income, so that you don't become a slave of money.
Absolutely.
You become a master of money. Now coming to second question. So let's say I have decided कि what should be my asset allocation. Uh, which asset classes do you think are more relevant for somebody who is starting his investment journey in say early 30s or late 30s?
I think given the scenario, which is, and I'm not expert across all asset classes, so this is a disclaimer. But I think a reasonable blend of equity, bit of debt, long-term FD, the way you want to put it, and then also in terms of the commodity aspect of it. When I say commodity, is more to do with gold, silver, because that is also an
Bullion.
asset class. It actually helps you have asset class or asset in terms of the US dollar parlance, because gold is a derivative of how the
So you
US
get a
dollar moves
currency
as well.
exposure
So
also.
you indirectly end up, yes, correct, with a currency exposure as well. I think these three parameters should be very much there. And then obviously, your house, that's a significant chunk of any middle class household. So that should matter if it matters.
So do you think in this system multi-asset fund can be a very good exposure, at least to start with?
Yes. So for someone who is really doesn't want to get into this game of trying to then look at asset allocation and move the asset allocation, who doesn't have enough time to go through these. I think it is a great strategy to invest across multi-asset category, because those categories kind of give you a reasonable return at much lower standard deviation. So I think for someone who is starting young and who really doesn't have enough time to invest and really look towards these portfolios, I think you said it right. Multi-asset gives you a great opportunity.
So in the month of September 17, SEBI came out with categorization of mutual funds. Before that, there was no standardization of categories. SEBI defined all categories of mutual funds. One category which was part of hybrid funds was multi-asset category. So SEBI said that if you want to call yourself a multi-asset fund, you need to have exposure across at least 3 asset classes. So 2 are very typical when it comes to hybrid funds, equity and debt. The third one, which was not that much common at that point of time, but because of this asset class became more common, I would say, was gold, bullion and REIT. So as we talk, a multi-asset fund will have at least 10% in 3 asset classes: equity, debt, and third one can be bullion, REIT, etc., etc. The good thing about this asset class is that they can have relative allocation across these asset classes basis their understanding of economy and markets. I'll tell you in very practical terms. So typically when economy is growing slow, money moves from equity to debt, and when there is a recession, it moves from debt to gold, and when there is even beyond recession, it moves out of even gold. The benefit or the beauty of investing in multi-asset is that your fund manager has the flexibility to decide how much amount he wants to have in equity, how much in debt, and how much in gold, basis his understanding of markets and economy. So next question to you, Pranav. What I should not do in the markets when it comes to investment, and I'll tell you the reason behind this question. I recently read one book, What I Learned About Investments from Darwin, and it talks about 2 types of error. One is minimizing your mistakes, and second is doing the right thing. And both these things will always move in opposite directions. So if you want to pick all the multi baggers, then your propensity of avoiding the mistakes come down. And if you want to avoid the mistakes, then your probability of picking the multi-bagger comes down. And the book very beautifully proves that that people think that it's about getting the multi-bagger, but it's other way around. It's about avoiding the pitfalls and mistakes. So that brings my next question to you. What are the mistakes that, let's say, first-time investor who is starting to invest in his 30s can avoid?
Try to differentiate first between news and data, or news
And noise.
and noise. Yeah, correctly put. Because when the party is going on, everyone is playing loud. And then suddenly things change, and then you are feeling wanted. So as I think Mr. Buffet put this across, when tide turns, you really understand who is swimming naked. So it's some similar parlance. So which is where it is important that you create your own framework, whichever suits you. Stick to the framework, stick to the discipline, as you rightly put, and the multi-baggers will be an outcome of these. See, there will be.
So you are saying make some principles and stick to them.
Stick to them. See, mistakes will happen as long as you tend to note down them and try not to repeat it in the same way, because there is always a learning curve and we always make mistake and always try to improve upon this. So it is always better to do that.
And probably one extension of what you said can be start with conservative principles, and then probably you can go more experimental as you start developing the confidence. So one thing is never deviate from your principles. Second, what you will suggest to the first time investor, what not to do in the market?
Basically, do your own research, and if possible, seek help from a professional. There is no harm in seeking help.
Not go DIY.
Yeah. So it is always better to listen to a few
Professionals.
professionals. Maybe you choose to do what you want, but at least take that advice and be always ready to have or understand the other side of it. If I'm putting money in, what could go wrong? And
Correct.
if you're more convinced on what could go wrong on that quantum will be lesser, it helps. And the other important thing is be willing to change. The economy changes,
So
things
don't be
change.
stubborn.
Don't be stubborn. When you realize that things are not working, change your style.
Correct. Great. So one last question, but the obvious question in these times: how do you look at Indian markets? Rolling out all thanks to Trump tariffs.
See, it is a very volatile situation. It is a very uncertain situation today. Uh, Incrementally, all I can say is today we still have a domestic economy which is doing reasonably okay. There will be a bit of a slowdown which one has envisaged over last year or two. But realistically speaking, if we understand the entire end game, and it could move out in very different directions, but there could be opportunities as well. So it is not that everything is going to be bad. So if you do believe that there will be certain opportunities, invest in those. So let me put it in a very simplistic way. What one can do in this scenario is US consumer can't just you know be left to US companies to
To
produce
be served.
and be served by those companies themselves. So there will be a trade partner which will be willing to have equal amount on the table. And if two biggies, the production house and the consumption house, are fighting among themselves, sometimes a neutral person ends up being a beneficiary. So I believe if the policy guidelines are in place, probably that neutrality will help us over the medium term.
So if I cite some numbers, 2.2% of India's GDP is exported to America, including merchandise and service. So merchandise, I think, will be 1 or 1.2%. Services, certainly Trump has not come down on them, right now. Comparative number for Vietnam will be 25%. For the countries like Malaysia, Indonesia, Thailand, these numbers will be in the range of 10 to 12%. Export to US. And even if we assume that they will, you know, harm Indian exports negatively, because why I'm saying even if we assume, because there is a counter view कि relatively speaking India is better placed. India can be a substitute for the countries like China, what they are calling China plus one strategy. But even if we assume that our exports suffer, do you think it's safe to say कि unless there is a huge ripple effect across the across the globe, everything tanks down, all supply chains breaks down, like happened at the time of Corona, is it safe to say कि India won't be as much harmed as it is made to be?
I'm really hopeful about it. The other aspect is you made a valid point. And even in terms of the what we are actually exporting to US, there are components like gems and jewelries. There are components like pharma,
Pharma.
apart from services, which are there. Something like a pharma, you may take a hit in terms of your realizations because of the tariff. But if it is compensated for volumes, your absolute level EBITDA could be similar.
Correct.
So
Correct.
somewhere down the line, it could actually not hurt us so badly as envisaged the way things are today. And obviously it will unfold over a period. So the point I'm trying to make is somewhere down the line, even this entire thing which is happening perhaps could end up being neutral to net positive in certain spaces. Maybe it may hurt gems and jewelry in some pockets, but the other sectors may actually end up being beneficiaries out of it.
So we can safely say कि India will range from being least impacted to being better impacted.
You can say that, but one never knows. See, there is
never.
always a risk that if you end up with China and US having a pact, then things change the other
Then
way.
things-
It also comes from my assertion that what can go wrong. So what can go wrong to the thesis is if they mend ways and they decide,
Correct.
then it is a different ball.
So your idea is कि when we come to analyzing all the scenarios, we should also analyze the most improbable or the worst case scenario as well.
Yeah, and then how are you placed in that?
Correct.
And over there also what happens is your domestic economy is still reasonably there.
Correct.
And that is what holds or keeps you in good stead.
So like happened in the time of Corona also. So after Corona, uh, India took the least time to recover from Corona among all the major economies, and probably it's only because of the resilience of domestic markets, as you rightly mentioned.
Absolutely.
Great. Thanks, Pranav. Thanks for all the knowledge that you shared with us. Really thankful, and I'm sure our audience will benefit a lot from it.
Thank you for having me.
So, for our audience, if you have any questions that you want to ask to us or any topic that you want to be covered, please mention it in the comment. We'll try to cover it in our coming episodes. Thank you. Thank you,
Thank
Pranav.
you.